Hi, I'm Mike Walther, founder and president of Oak Wealth Advisors, with a summary of the new Trump accounts. These are going to be new savings accounts for children, where up until age 18, contributions can be made to fund the accounts. And then after the child turns 59 and a half, like any other IRA or other retirement account, after that age, they can take out penalty-free withdrawals. So there's going to be a penalty if they want to take money out before age 59 and a half, but for now, the focus should be on funding the accounts and building up the value. There's a $5,000 annual contribution limit, and if the government puts in the first $1,000, that would leave the family another $4,000 of additional contributions for the year. And depending on where you live, you may be eligible to get a $250 contribution one time from the Dell Foundation. And the contributions can start on the 4th of July, 2026. So, in summary, $5,000 contribution limits up till age 18. After that point, it becomes essentially an IRA account for the individual. There's going to be two periods to keep in mind. As I mentioned, up till age 18, it's a growth period. We're doing all the funding during that period. After age 18, it's post-growth and the rules are a little bit different. So up until age 18, it's contributions and no distributions. So no matter how much you want to take the money out for whatever purpose, under current law, there's no way to get the money out. And there'll be investment restrictions. All these accounts must be invested in a U.S. stock index fund that is inexpensive, less than 10 basis points or 1/10 of 1%, which actually is a good growth vehicle. So the rule around that is going to be a growth investment in U.S. stocks, and the individual will be the only beneficiary on the account. Now, after they turn age 18, distributions are allowed, but those will likely come with both penalties and taxes. So there should be some advice given, or at least reviewed, before taking distributions after age 18. And if they'd like, they can convert their Trump account after age 18 into a Roth IRA, which would be a one-time tax at that time of distribution and conversion. But the Roth IRA then grows tax-free, and future distributions from that Roth, which might be at a much bigger valuation later in life, would also come out tax-free. And the individual gets to make that decision because after age 18, it's their account. They make the decisions during the post-growth period. Now, you're probably wondering, how do I get one of these things open? Well, you're going to use either Federal Form 4547 or simply go online at trumpaccounts.gov where you can fill out the form and get the account opened. When you first open the account, it'll be at BNY Robinhood, which is the company that's going to hold all these accounts initially, which makes it easier for the government to fund them if they know they're all at one place. Then, at some future date, yet to be determined, you'll be able to move the account from BNY Robinhood to whatever custodian you'd prefer to hold it at. We don't know what those will be yet, but that's what they've told us we're going to be looking for in future years. And it's also important to understand that while one individual is going to have the account in their name, the child, anyone can contribute to it up to the $5,000 annual contribution limit. So understand when you're making a gift to a Trump account, because there are no distributions allowed until age 18, they're not considered to be completed gifts, and they will likely require that a gift tax return be filed because they're not going to be eligible for what's known as the annual gift exclusion amount, which for 2026 is $19,000. That's the amount you can give to anybody and not have to file a gift tax return. So keep that in mind if you're planning on funding into a Trump account, and there may be a gift tax filing requirement that you should check with your accountant to see what your requirements may be. Also, there's a potential that we've come up with, and if you want to contact us, we can talk about how maybe get around the gift tax filing requirement. Finally, during the growth period, we want to make sure that we understand how they're being invested. You'll have some choice there, but again, I mentioned it's going to be in a mutual fund or exchange-traded fund that costs less than 10 basis points or 1/10 of 1%. And interestingly, a few states that includes both Wisconsin and California, where we have a number of clients, they plan to tax the annual earnings in Trump accounts. Most states will not be taxing it. They'll be treating it more like an IRA account, where the growth within the account is going to be tax-free. But if you're in Wisconsin, California, or you're not sure, reach out to Oak Wealth Advisors or your advisor and find out for sure whether or not you're going to be facing taxes on the growth of the account. So if you have any questions, by all means, reach out to your advisor at Oak Wealth Advisors. Check us out on the socials. Listen to our podcasts, especially these voice podcasts on Spotify. Hopefully you'll learn some things from some disability industry leaders. And we hope you find this information to be useful. And if you have any questions, we're always available and understand that everything we talked about during this presentation is a summary of a brand new plan. You should check with your advisor before implementing anything, and don't assume that anything we told you is going to be locked in stone forever. This is new, things will be changing, so understand that you should always get your own personalized advice from your advisor and your accounting firm with respect to all your taxes and your planning. With that, we wish you all the best.